Banks don't want you to hear this. Artificial intelligence is quietly changing money forever. From how we spend, to how we save, invest, and even borrow, AI is rewriting the rules of finance in 2025. Today, I'll show you exactly how it's happening, and why traditional banks are terrified. This isn't a prediction, it's already underway. Every swipe of your card, every transfer, every late bill, and every trade feeds a learning machine that decides what you can do next. By the end of this video, you'll understand where the power is shifting and how to position yourself to benefit, while avoiding the traps. AI inside the bank: faster, cheaper, and relentless. First, AI is replacing humans inside the banks themselves. Not with humanoid robots behind the counter, but with software that does the unseen work at industrial scale. Underwriting engines ingest thousands of data points and approve loans in seconds. Risk models scan portfolios continuously and flag problems before a human could open the spreadsheet. Compliance systems read mountains of emails and chat logs to detect insider risk. Customer service chatbots resolve the common issues at any hour, learning from each interaction to raise their first contact resolution rate. The result is speed. Account openings, credit decisions, and wire approvals happen in minutes instead of days. That speed saves banks money, but it also concentrates power. If an algorithm misclassifies you as risky, the denial can be instantaneous, and the appeal can feel like arguing with a wall. Fewer manual checkpoints mean fewer opportunities for a helpful human to say, "Wait, this doesn't make sense." The machine's verdict becomes the default. How AI is rewriting credit scores. Second, AI is changing how credit scores work. Traditional credit models looked at a small set of factors: on-time payments, credit utilization, length of history, and inquiries. Modern AI models watch your financial life in motion. They analyze spending habits, income stability, subscription churn, cash flow timing, and even the devices you use to log in. Some lenders weight the time of day you pay your bills, the merchants you frequent, and how your balances fluctuate after payday. That shift is like upgrading from a blurry snapshot to a live, high-definition stream of your financial behavior. If you're chronically late on utilities, your score can react faster. If you build a positive habit of paying early and keeping balances low, you can be rewarded sooner. But the granularity cuts both ways. Minor anomalies, a travel splurge, a temporary cash crunch, or a new gig with irregular income, can trigger caution flags you never see. The lesson is simple: assume your money life is a live feed, not a monthly report. Consistency matters more than drama. AI in investing, from billionaire tools to your pocket. Third, AI is disrupting investing. Robo-advisors already manage diversified portfolios, harvest tax losses, and rebalance automatically. High-frequency firms and quantitative hedge funds use machine learning to read order books, analyze shipping traffic, and mine alternative data for edges measured in milliseconds. But the real revolution is accessibility. What used to be locked in a hedge fund's lab now arrives as consumer tools. Trade co-pilots that simulate strategies before you risk a dollar, risk analyzers that flag concentration and drawdown risk before they spiral, and idea engines that surface undervalued sectors based on fundamentals, momentum, and macro signals. This doesn't mean every retail investor becomes a wizard. It means the cost of avoiding obvious mistakes is collapsing. When a co-pilot tells you, your last 5 trades all increased your exposure to the same factor, you can fix it in seconds. Banks hate that because it levels the playing field. Advice that used to cost hundreds per hour now whispers in your ear for a single subscription fee. AI for personal finance, advisors in your pocket. Fourth, AI personal finance apps are quietly replacing bank advisors. Apps like Clio, Copilot, Monarch, and their competitors connect to your accounts, auto-categorize spending, and forecast cash flow week by week. They nudge you before you overdraft, negotiate bills on your behalf, and suggest savings targets tailored to your income pattern, not the average person's. Some build envelopes around your goals and lock discretionary money behind soft paywalls so you don't sabotage yourself late at night. Others coach you in natural language, turning confusing bank statements into plain English insights you can act on. Why pay a bank advisor $300 an hour to deliver a generic plan when an app can give you personalized advice instantly? That is exactly why banks are nervous. The monopoly on financial guidance is gone, and the convenience bar is higher than any branch can match. AI and fraud. Protection with a powerful pause button. Fifth, AI protects and controls money. Fraud detection systems now score each transaction in real time by comparing it to the behavior of millions of legitimate and malicious events. That means stolen cards can be blocked faster, account takeovers can be throttled mid-attack, and mule networks can be mapped and disrupted. The flip side is control. The same pattern matching that stops a thief can also freeze you when you look like an outlier. Traveling without notice, moving a large sum between new accounts, or sending money to a first-time recipient. It's a seatbelt with a handbrake built in. Most days you barely feel it. On the day you need money urgently, the system might say hold on and demand verification. Understand the trade, better safety and faster recovery, but more checks and occasional false alarms. Prepare with strong authentication, backup payment methods, and a travel note before you go abroad. Digital currencies and the data layer. Sixth, digital currencies are accelerating the shift. Around the world, central banks and private firms are experimenting with digital money rails that settle faster and carry richer metadata than traditional infrastructure. Layer AI on top, and a payment is no longer just a transfer. It is a data packet that can be scored, routed, taxed, credited with rewards, or flagged for review, nearly instantly. Advocates argue this reduces fraud, shrinks costs, and expands access for people left out by legacy systems. And it makes programmable money a realistic policy tool. Critics warn about privacy, surveillance, and the risk that rules can be hard-coded into the money itself. If cash disappears, the ability to transact without being tracked disappears with it. Banks are paying attention because when payments become software, the power to design the rules shifts to whoever controls the platform. In some models, that won't be a bank. The opportunity shift, how regular people benefit. So what does all this mean for you and me? It means leverage. AI can help you cut fees, avoid mistakes, and make better, faster decisions without spending every evening in a spreadsheet. Freelancers are already turning AI into income, building bookkeeping automations for small businesses, offering cash flow audits, and preparing tax documentation with fewer errors. Students use AI to draft scholarship essays, compare loan packages, and model repayment plans. Side hustlers price products with dynamic rules, and forecast demand so they don't over or understock. Households build sinking funds, automate savings sweeps on payday, and set smart alerts that warn about bill spikes before they hit. The point isn't that AI replaces effort. The point is that AI multiplies the return on every minute you invest in your money life. It's like having a financial analyst, a bookkeeper, and a tireless accountability partner sitting on your phone. The fine print, risks, bias, and discipline. Let's be honest about the risks. AI makes good decisions cheap, but it also makes bad decisions cheap. If a model is trained on biased data, it can systematically underscore certain groups. If it's overfitted to last year's market, it can fail exactly when conditions change. If you treat a chatbot like an oracle, you can end up with confident answers that are directionally wrong. The antidote is governance. Use AI to codify your rules, not to abandon them. Write an investment policy that sets your target allocations, contribution rates, and rebalancing bands. Keep human review for exceptions and escalate anything that feels off. When you borrow, compare offers from multiple sources. When you invest, verify fees and tax implications. When a machine denies you, exercise your right to appeal. AI is a power tool. In the right hands, it's transformative. In the wrong hands, it's dangerous. A practical game plan for 2025. Here's a practical playbook you can implement this week. Step 1. Unify your data. Connect all accounts, banking, credit, brokerage, loans, into a single AI-enabled dashboard so you can see cash in, cash out, and upcoming obligations at a glance. Step 2. Automate the easy wins. Move recurring bills to automatic payment, schedule transfers to savings on payday, and switch to low-fee or no-fee accounts where possible. Step 3. Define your investment core. Choose a diversified, low-cost portfolio aligned with your timeline and risk tolerance, then let automation handle the maintenance. Step 4. Deploy an AI copilot for decisions. Before you make a big purchase, Run a scenario. How does this affect next month's cash flow and your emergency fund? Before you place a trade, stress test it against past volatility. Step 5. Audit your security. Turn on two-factor authentication, set travel alerts, and maintain a backup bank or card to survive an unexpected freeze. Step 6. Create review rituals. 10 minutes on Friday to check trends, 30 minutes monthly to adjust rules, and one deeper quarterly audit to re-anchor your plan. Why banks are nervous? So yes, banks are scared, and not because the future is evil, but because the future is unbundled. For decades, banks sold access to capital and expertise as a bundle. You deposit, they advise. AI splits the bundle. Capital is accessible on digital platforms, and expertise is increasingly encoded in software anyone can rent for a few dollars a month. The moat shrinks. Some institutions will adapt, turning themselves into open platforms that plug into the same AI engines you use. They'll compete on trust, service quality, and unique product design instead of sheer branch count. Others will retreat, adding friction, lobbying for protection, and quietly blocking tools that expose hidden fees. You don't need to guess which is which. Watch how they handle data portability, third-party connections, and transparency about pricing. The leaders will make it easy to leave, because they plan to win you back with value. Ethics and guardrails, what we must demand. As users, we also have a role in shaping the system. Demand transparency. If an algorithm denies you, ask for the factors that drove the decision and the steps to improve. Support explainability. Prefer services that show inputs, thresholds, and confidence, not just a binary yes or no. Value privacy. Choose apps that minimize data collection, encrypt end-to-end, and give you export and delete controls. Encourage fairness audits and human appeal channels. None of this is anti-technology. It is pro-accountability and user dignity. The goal is not to slow down innovation. The goal is to speed up trustworthy innovation, where the models are accurate, the appeals are clear, and the incentives reward long-term financial health, not short-term clicks. What this means for your next 90 days. If you do one thing after this video, do this: run an AI financial audit on yourself. Pull the last 3 months of transactions into a budgeting app. Tag the noise, find the leaks, and set 3 automation rules that save you money without thinking. Draft a 1-page investment policy and let an AI enforcer rebalance when markets swing. Create a security checklist, strong authentication, travel mode alerts, a plan for account freezes, and a backup bank for emergencies. In 90 days you will feel the difference in control, clarity, and confidence. You will spend less time worrying and more time executing a plan that compounds. The takeaway and what's next. Technology is giving regular people access to tools that only the financial elite use to control. The future of money is AI-driven, and you can either adapt or be left behind. If you were shocked by how much power algorithms now hold over credit, investing, and even day-to-day spending, remember this: the same tools that can judge you can also coach you. Use them intentionally. Make the model your ally. In my next video, I'll show you 3 AI hacks to manage your money smarter than any bank advisor, and I'll demonstrate them step by step. Which part shocked you the most? Drop your reaction in the comments. Share this with a friend who needs a money reset. Subscribe for the follow-up tutorial. The rules are changing. Now you know how to use them.